So I've got some questions prepared for Neel, but part of this is definitely an interactive conversation. So we definitely want to have some participation and questions from the audience. So we'll get the conversation started, but there will be a couple of microphones going around, and make sure to flag them down. And I know that in talking with Neel that he's very interested in hearing remarks and questions from the audience as part of today's conversation. So make sure and feel free to ask tough questions. Don't be shy in today's conversation. So I wanted to state that before we begin. So Neel, I know that in some of these conversations, a part of your interest in having these sorts of events is to talk a little bit about the Fed's role and what you do. So if you want to start there for us.
So first of all, thank you for having me, and all of you, thank you for taking time out of your busy Friday afternoon to visit with me. I always like to start just by level setting and talking about what it is the Federal Reserve does, and importantly, why is there a Minneapolis Fed? Why are we here at all? You know, so the Federal Reserve, you probably know this, is our nation's central bank. And Congress has given us what we call a dual mandate. One mandate is stable prices. You can think of an economy that's not overheating, but not growing too slowly, steady growth. And then second, maximum employment. How do we have an economy where everyone who wants to work is able to get a job and work? And sometimes those two things are in tension. If the economy is overheating, we might need to cool it down by raising rates. If the economy is limping along, we might need to boost it by cutting interest rates. Now, why do we have a Minneapolis Fed? So if you go back in American history, and I've read a lot about the Revolution and the Constitution, et cetera, our nation has always hated the idea of having a central bank. And the reason is because it sounded mysterious. A bunch of bankers in a dark room doing God knows what. It all just sounded very undemocratic. So Alexander Hamilton created the first central bank, and it lasted a few decades, and they got rid of it. And then our economy in the 1800s, the late 1800s, was hammered with financial crises. And then there was a big one in the banking panic of 1907. So the US Congress said, well, we still hate the idea of having a central bank, but if we have to have one to manage these ups and downs, let's not have it concentrated in Washington, D.C. Let's have a separation of powers, and let's have it distributed around the country. So Congress created the Board of Governors of the Federal Reserve. You've probably heard of Janet Yellen. She's the chair of the board. Before her was Ben Bernanke. Before him was Alan Greenspan. They're all appointed by the President of the United States, and they're confirmed by the Senate. And then Congress created 12 independent regional Federal Reserve banks, including the Federal Reserve Bank of Minneapolis. And what's different is I'm not appointed by the President of the United States. I was not confirmed by the United States Senate. I was appointed by a local board of directors of local leaders of our region, and I report to them. So actually, one of my directors is paying me a surprise visit. Harry Melander is somewhere here from St. Paul. There's Harry. And he's representing this region. And his job is to make sure I'm doing a good job representing our region. So our region includes Minnesota, North and South Dakota, Montana, the Upper Peninsula of Michigan, and part of Wisconsin. So a big part of my job is to travel around the region to learn, hear directly from constituents, all of you, what's happening in your local communities, what's happening in your businesses, what's happening in your job market, so that when I go back to Washington, D.C. 8 times a year and we set monetary policy for the nation, and I was just there this week, we can talk about it, part of my job is to speak about what's happening in our local economy. So these town hall events that we're doing are really important to me, hearing from you, learning from you, so that I'm more informed about what's happening here in the local economy. So that's why I'm glad to be here. I'm glad to hear from you, and I want you to be really candid and direct with me, because that means I'm going to learn from you, and that's a big part of why I'm here. So thanks a lot for being here.
Great. Thank you for that background and setting that framework. We appreciate that background. So you mentioned you had your FOMC meeting this week, Federal Open Market Committee, where Janet Yellen is the chair, and talked about interest rates. So maybe you could give us some results of that meeting and an overview of some of the things that were discussed.
Sure. So we met on Tuesday and Wednesday. It's a 2-day meeting, and on Wednesday afternoon we put out a statement saying here's what we've agreed to. And the committee agreed, and it's a voting process. We voted unanimously to agree to hold interest rates steady, not to raise them, not to cut them, just to hold them steady. The key things that we've all been looking at is what's happening in the job market. And in the last few years, the job market around the whole country has gotten a lot stronger. The economy nationally has been creating a lot of jobs, around 180,000 jobs a month, which is more than is needed to keep up with population growth. So more workers are entering the labor force, going back to work. The headline unemployment rate has been dropping nationally. That's a really good thing. But we know it can't drop forever. At some point, if the unemployment rate drops very, very low, what will end up happening is all of the businesses will be competing for workers. There won't be enough workers. They're going to have to raise wages, and then you would expect to see wages start to climb, which then can lead to higher inflation. So we're always looking at what's happening in the job market, what's happening to wages, what's happening to inflation to assess where we are in our dual mandate. So that was the height of this discussion. The job market continues to be strong, but it's really curious. We had expected to see wages growing more quickly. We had expected to see inflation starting to climb. But much to our surprise, and this is a good thing, the job market's been strong. Unfortunately, wage growth has not been very strong, and there's been very little sign of inflation picking up. So this was the discussion that we keep having, and we decided let's not do anything with interest rates. Let's wait to see more data.
Great. So there were hikes earlier this year. There was one in March and June, and Neel was the lone, I believe, dissenting vote on that because of inflation, or you can expand on that. But why were you the sole dissenter? What are you seeing that they aren't, or maybe what is their argument for rates that you're not agreeing with?
Well, one of the concerns, you're right, in March and in June, I voted against our 2 interest rate increases, and I was the only one to vote against it. The concern on the other side, so one concern is for the last 5 or 6 years, inflation has been coming up below our target. We've set a target of 2% inflation per year, what we define as not too hot, not too cold. And it's been coming up a little bit low year after year after year. The concern that some other people have is, well, if the job market gets tight, inflation might all of a sudden accelerate. You could see wages pick up, you could see inflation then pick up, and then the Federal Reserve will have to move very quickly to try to slow things down and cool the economy down. I understand that argument, but it's an argument people have been making for 5 or 6 years. And for 5 or 6 years, it's been wrong. And so my point to my colleagues is maybe the world has now changed and maybe inflation is going to accelerate, or maybe we're repeating the same mistake we've been making for 5 years in a row. I think we're likely repeating the same mistake. So why don't we wait until we see inflation start to move back towards our 2% target? And so, look, reasonable people can disagree. I can tell you this. I know we all watch politics in Washington, and it can be very animated, a lot of emotions. I can tell you this, at the Federal Reserve, everybody around the table are there with a true sense of public service. There's no politics. It literally is good-natured people doing their very best, looking at the data, trying to make the best decisions they can, and reasonable people can disagree. And so we've had some disagreements, but I think we're all honestly trying to reach the right conclusions.
Great. Thanks for that insight. One of the things that you have supported, you've voted against the rate increases, but you have verbalized some support of reducing the Fed's balance sheet.
Correct.
How do those correlate, or what's the argument for one but not the other?
Sure. So the way we try to affect the economy traditionally is by moving short-term interest rates up and down. Now, when you all are buying a house or taking a loan out to expand your business, you don't just care about what the overnight interest rate is. You care about what's the interest rate over the next 5 years or over the next 10 years. So the way we really affect the economy by moving short rates around is by having some effect at long-term interest rates, because that ultimately is what drives investment decisions. Well, when the financial crisis hit and we had the Great Recession, the Federal Reserve cut interest rates to 0. But then the question was, the economy was still limping along. Are we out of ammo? Well, the Federal Reserve, I think, appropriately said no. Take short-term interest rates to 0, but we can affect long-term interest rates by buying long-term bonds. So if the Federal Reserve bought long-term Treasury bonds, that would bring yields on long-term Treasury bonds down, which would affect long-term rates, which would then affect your cost to get a mortgage or to get a loan to expand your factory or your business. So now we have this $4.5 trillion balance sheet when before the crisis it was less than $1 trillion. And the question is, when are we going to shrink that balance sheet back down to normal size? So you're right, I have been in favor of us slowly bringing that balance sheet back down to a more normal size, even though I'm still concerned about inflation. And the reason I reconcile those two positions is that I think the big balance sheet isn't doing a lot to boost the economy right now, but I do think there are big costs in terms of public confidence in the Federal Reserve, because a lot of people are concerned about it. And so what I want us to do is start shrinking that balance sheet by letting it gradually roll off as the bonds mature, have that happen in the background over the next several years. Meanwhile, we can focus on inflation with our short-term interest rate and get back to a normal, quote-unquote, normal policy environment. I know that's a complicated topic, but there's a lot underneath that, and that's why I've advocated what I've advocated.
Great, thanks for addressing that.
Sure.
So you've touched on employment, inflation, interest rates. One thing we haven't touched on is GDP growth, and GDP growth has been slower than some people would like, or a concern for some. A popular explanation for that is something called secular stagnation. And is that an argument that you would agree with, or an explanation for the slow GDP growth?
Well, secular stagnation is a term that's actually a very old term that has been recently brought back to life. And it's the notion, one way of explaining it, it's the notion that after you have a major financial crisis, economies are very slow to recover. And in some level, I'm sympathetic with that. Think about that. In '08, our economy had effectively a massive heart attack. The good news is with the Fed and Treasury and Congress, we stabilized the heart attack. We did not end up in the Great Depression. But after you have that major heart attack, you know what? You're going to have a long, hard recovery. And in many ways, we've been having a long, hard recovery. That's kind of a big picture way to look at it. But if you dig deeper, where does economic growth come from? It comes from population growth, so more people buying cars and food and homes. So part of it is more people, and part of it is productivity growth, so technology development, et cetera. Well, as a society, we're all having fewer kids than we had 20 or 30 years ago. And by the way, 20 and 30 years ago, we also had this big boom because women were entering the workforce in mass for the first time. So that ended up being a lot more workers, which was very good for our economy. Well, now women are in the workforce, so there's no new wave to happen from women entering for the first time. But we're not having kids at the same rate we used to. So if we have slower population growth, then we're likely going to have slower economic growth unless we can do something about that fertility rate, right? You know, you laugh, but you could subsidize fertility. You could pay for childcare. You could offer tax credits to young families to have kids. I mean, it's expensive, but it's not unprecedented. Other countries are trying to do it. Or you can embrace immigration. And immigration has been a big source of economic growth for America throughout most of our history. That is also slowing down. So just from I'm going to come to productivity in a second, just from a people perspective, you can either accept slower growth, you can try to get fertility up, or you can embrace immigration. That's math. And you, the public, get to decide which of those three choices you want, but that is math. The second half of the equation is productivity growth. And for the last decade, productivity or innovation in our economy is much less than we've been used to. And nobody has a good explanation why. One theory that I have some sympathy for is the stuff that we've been innovating in the last decade just isn't that important. So think about this. 50 years ago, we had the integrated circuit. 100 years ago, we had the internal combustion engine, or we had the airplane, or we had electricity, big transformational technology. You know, relative to electricity, Twitter is not that impressive, okay? On Twitter and Facebook, we think it's so cool. The wizards in Silicon Valley are very pleased with themselves. But the truth is, in the scale of the global economy, it just doesn't matter all that much. And so I hope that we as a society can innovate on things that really do matter. So things like self-driving cars, that may well be transformative in terms of productivity growth. If all of a sudden people are freed up of long-haul truckers, can do something other than just sitting behind the wheel. Now, it may be very tough. If you're a truck driver, this can have a big impact on your life. But in terms of national productivity growth, we need things that really move the needle. And Twitter and Facebook, in my book, do not move the needle.
Okay, so you touched on technology, you touched on immigration, and all that, how that goes into productivity. If those are some of the dynamics, what sort of policy might you recommend to help spur long-term growth in the U.S.?
Well, we talked about immigration, so that's a key one for economic growth. Another one is education. The fact of the productivity is directly related to how skilled our workforce is. And so making sure, one of my surprises in coming to Minnesota has we have a lot going for us, right? We have a very diverse economy in terms of all the major sectors of the U.S. economy are represented here. On average, we have a very highly skilled workforce. On average, we have very good schools. But if you scratch beneath the surface, we have massive disparities. So the averages are very good, but there are big, big gaps along racial and geographic lines. And so making sure that everyone in our community gets that good education, is able to get access to either trade schools that follow high school or four-year degree, continued skill development is a key part of improving our local competitiveness and improving our national competitiveness. So that's one specific policy tool. And then things like research and development. There is a role for government to support basic research into sciences and technology. That also is, I think, is a place that the government, state, local, federal government can play a role.
Great. So I'm going to kind of jump ahead. You mentioned education, and you've been developing the Fed something called the Opportunity and Inclusive Growth Institute. Maybe you could talk about that, what kind of role it might have in our local, regional, national economy.
Sure. So I talked about the surprise to me coming to Minnesota and finding these gaps. Now, these gaps exist nationwide, but I didn't expect to find them here in as large a range as they are. And so I started asking basic questions. Why do these gaps exist? I'll give you an example. In America today, actually in any time, African American unemployment is always twice white unemployment. Now, so if it's a recession and white unemployment is 6, African American unemployment will be 12. If it's a booming economy and white unemployment is 3, African American unemployment will be 6. And even if you compare college graduate against college graduate, it's the same ratio. If you compare high school dropout against high school dropout, it's the same ratio. So I started asking, why is that? What are the structural factors that lead to this constant gap? And I got very few good answers. The Federal Reserve as a system employs more PhD economists than anyone in the world. So if anybody should be able to answer this question, it should be researchers at the Fed. I got surprisingly few good answers. And so I talked to Janet Yellen about this, our chair in Washington, and we said we need to do our part. We know monetary policy probably cannot solve these gaps, but if we can do the research that analyzes them, then we can arm other policymakers, such as state legislators, some of whom are here in the audience today, or governors or the federal Congress, give them the data and the analysis they need, then they might be able to help close some of these gaps. And let me give you a very specific example. So long before I joined the Minneapolis Fed, a researcher named Art Rolnick was our research director, and he came out very strongly against the state of Minnesota spending all this money on stadiums, saying that this is not a good use of taxpayer money. It didn't make him very popular, but I got to tell you, he was actually right. But somebody said, okay, smart guy, if you don't think spending money on stadiums is a good use of money, what is a good use of money? So he did the research, and he found the highest return on investment was investing in early childhood education. So he started going around educating people on the value of early childhood education from a return on taxpayer investment perspective. And I think it's really made a difference. Right? The state of Minnesota, more than most states, has gotten behind early childhood education. There's still debates on exactly how you implement it, but I think this state has, by and large, got behind that message. That's an example of the kind of research that I think we at the Fed can do. Non-political, non-partisan, we will show you the facts, we will show you the analysis, and then it'll be up to the state or the federal government to decide whether or not they want to take it forward. That's the kind of research that we hope to do to arm elected leaders with the data they need to take it forward.
Great, thanks for sharing that. So I'd like to switch gears a little bit, but are there any questions in the audience prepared? Can I see if anybody's ready? Let's take a couple from the audience.
Sure.
Yeah, great. Sir, go ahead.
Could you say who you are, too?
Yeah, just a question regarding the outlook on the national debt and the impact on the economy and the future of America.
Sure. So our federal debt situation long-term is a real challenge, and it really comes from our underfunded entitlement programs. Most of our entitlement programs are designed that current workers pay for current retirees. So as our society has aged and our population growth has slowed down, those ratios are now out of whack, and they don't work anymore. And so we as a country have to make some tough choices. Either the levers are clear. You can either raise taxes, you can change the way benefits grow, you can cut benefits. These are fundamentally political choices that we have to make on how to bring these programs into balance. Ultimately, at the end of the day, math always wins. So we can play denial, we can point fingers at each other, but at the end of the day, math will win, I promise you. The question is how much time we have before that reality shows. Now, what we have going for us is that the U.S. economy is still, we have our problems, but we're still stronger than everybody else. And so global investors still turn to America as a better place to invest than Europe or than China or than the rest of Asia or than Africa. So the clock is right now with us, but if we don't get our act together, imagine this, if Europe can get their acts together, all of a sudden global investors will say, well, that may be a better place to invest. Then all of a sudden our clock will start ticking a lot faster than it is right now. So this is a reality we need to deal with. It's not a burning issue that it's about to create a crisis right now, but we also can't ignore it.
We have another question? Yeah.
Oh, yeah.
It's working?
Yep.
My question is, to what extent does the Fed include considerations of food and healthcare in the calculation of inflation? I've always read that, those food and energy are very volatile, so they try to keep those. But, as we go to the grocery store, food is getting more and more expensive, and healthcare every year is notoriously getting more expensive. So at a household budget level, to what extent do you include that in your discussions?
We do. We actively include it. There are independent government agencies that have teams of economists that are always looking at these different baskets of goods that households have to buy. Everything from your rent, home prices and what's happening there, to healthcare costs, to food, to energy, to gasoline, et cetera. So our goal, when we say 2% inflation, is headline inflation. That includes everything. But when we try to predict where headline inflation is going, especially energy, oil prices bounce around a lot. So to predict headline inflation, we look at what's happening in core inflation, which excludes food and energy just because they move around so much. So our goal is headline, but the best predictor of future headline is current core inflation. That's why we look through it. So we do actually care about headline inflation a lot. That's our goal. But we're always trying to look for what's the best forecaster, and that's why we strip those out just in the analysis. Thanks for your question.
If we can get this gentleman a mic here, but sure. Yeah, thank you. We'll get you a mic. First of all, before we get to your question, right there, I want to make sure while you're here to touch on a subject that you've been outspoken about, which is too big to fail.
Sure.
And you've talked about this and the risk associated with it. If you could give us your assessment of the issue in general and the risk associated with it.
Sure. So this is burned into me. So in 2006 to 2009, I was at the Treasury Department. I was one of the first responders, and I ran the TARP program. Right. This is like the least popular economic program in American history. I mean, no kidding. My old boss, Hank Paulson, used to joke, but it's only a little bit of a joke, that 60% of Americans are against torture. Waterboarding. 90% were against the TARP. All right. So it was the right thing to do, because if all the financial system had collapsed, we would have been in a Great Depression scenario. So bailing out the banks was the right thing to do because of where we were, but we never, ever, ever want to have to do it again. And I want to make sure that nobody's put in that position again the way Congress was and the administration was in '08 and '09. And so my message to you is the biggest banks in America are absolutely still too big to fail. Don't let anyone tell you otherwise. We have not solved the problem. We spent all of 2016 analyzing this, getting the best experts from around the world to come to Minneapolis to look at a range of options. We've released a draft plan that we call the Minneapolis plan that tries to address this. The big banks hate it. That's fine. That tells me we probably got it right. And in short, the biggest banks need to have about twice as much equity capital as they have today. That's the buffer that protects taxpayers in case they make bad investments. I'll give you an example. If you go to get a home loan, I got a home loan a year and a half ago. The bank made me put 20% down. The reason I had to put 20% down was to protect the bank in case I ran into financial hardship. That's what capital is. So if we make the big banks put 20% down on their investments, we can protect taxpayers. And so I'm talking to Republicans and Democrats, House and Senate, anybody who'll listen. We need to take care of the too big to fail problem, and we need to relax the regulations that are smothering community banks. If we do those two things, our banking sector will be in a much, much stronger position.
Great. Thanks for touching on that. Go ahead, sir.
Yes. Now that Congress has moved on from health care, I think they're going to be focusing on tax reform, tax cuts. Speak to the importance of cutting corporate taxes to accelerate that GDP. Is that the key, and what would you like to see in tax reform or tax cuts?
Well, to me, the key is, if it were up to me, and is tax reform. That means tax cuts is just increasing the deficit and lowering tax rates. Look, anybody can spend more money and have higher growth, and that's essentially what deficit finance tax cuts are. But that, to the gentleman's question about the long-term deficit, that doesn't help us with the long-term deficit. Tax reform means you reduce some taxes, you raise other taxes, you streamline the overall system by cutting out loopholes. So, for example, most large American companies don't pay anything near the corporate tax rate because they take advantage of loopholes and deductions and accountants and lawyers. Well, if we got rid of the loopholes and deductions and we had a fairer tax system with a lower average tax rate, you could actually have a revenue neutral reform that's much more efficient so that they're not spending money on accountants and lawyers, they're spending money on research. Right? That's a better, smarter tax system. So for me, it would be something growth-oriented in that regard, where you reduce complexity, you increase fairness, and you have tax reform rather than just a deficit finance tax cut. I think that would be the best thing for long-term economic growth in terms of the tax code. Sure.
Go ahead, sir.
Yes, could you expand a little bit on your views on immigration, and specifically, what does a balanced and constructive policy on immigration look like to you?
Sure, and I'm going to confess I'm biased here. I'm the son of immigrants and I'm married to an immigrant, so you may say that I'm talking my own book. Maybe I am. Personally, for me, I think we need an immigration system that matches what our economy needs. And so instead of first come, first serve, or instead of somebody has family relationships, how about looking at what the businesses in our economy need? What are the skills that our economy need? So if you look at Canada, Canada has a system that's very skills-oriented. They have certain skills that are in high demand. Those are the top of the list. That sounds pretty smart to me. You know, we have a huge advantage in our country because the best and the brightest around the world would love to come here. We welcome immigrants. We assimilate them in our economy, in our communities, in our society. By the way, I'm a great example of this. So son of immigrants, getting to be the president of a Federal Reserve Bank, getting to work in Washington, D.C. This is a great country that truly embraces those who want to be here and want to work hard and contribute to our society. And so to me, I would make it skills-oriented and really prioritize the skills that our economy needs. And that's how I would do it. And with a mapping towards how many people our economy needs to achieve the kind of growth that we want. That's one person's opinion, and we could all, I'm sure we will debate this as a country.
Like one or two more questions. Do you have another?
Yes. So you touched on mathematics with employment. So a few years ago, we were talking about how the numbers were increasing with employment, Is that true employment or is that underemployment?
Well, we have a number of different measures of employment. So what we call the headline unemployment rate, and this is what gets the most attention in the press, has fallen to around 4.5%, from a peak of around 10%. But that only includes people who are actively looking for work. Then there's another measure of people who are stuck in part-time jobs or maybe who've given up looking for work. And then there's yet another measure of what percentage of the overall population is actually in the workforce. So we look at a bunch of different measures. That headline rate has come down a lot. And even the people who've given up looking or the people who are stuck in part-time jobs, those have also come down to near levels they were before the crisis. But if you look at working age folks, roughly 25 to 55 is how the economists categorize it, that percentage of our population that's in the labor force is still a lot lower than it was in 2006. So on some measures, the job market still has a ways to go before it was as healthy as it was back in 05, 06. Sure.
A comment to that. So you got all these millennials that us baby boomers created, so I can't pick on them. Think about the skill sets, what's going on in our country, because manufacturing is out, where basically all the jobs are going overseas. What are these individuals going to do for work in our country besides live in our basements?
Well, there's obviously a lot of folks in this audience agree with you. Our economy has managed to people have predicted the end of work for a long time. So when people were bringing automation to farms, others said, oh my gosh, this is the end of labor. And then workers moved into factories and the jobs changed. So the nature of work is constantly changing, and it can be very disruptive. Again, if you're that truck driver and now come self-driving long-haul trucks, that's very disruptive to you. So I don't want to minimize that. But the nature of work is changing. If you look around the Twin Cities, the unemployment rate in the Twin Cities is around 3%, the official unemployment rate. So there right now, when I travel around the district, the number one thing I hear from businesses is, I can't find workers. So if your son or daughter is living in your basement and says they can't find a job, have them come see me, because there are lots of businesses that say they can't find workers. And a lot of businesses, I will say, why don't you raise wages, or why don't you train the workers yourself? You can't find a skilled electrician, why don't you train them to be an electrician? Then they tell me, we can't find people who want to work and who are prepared to work 5 days a week, 8 to 10 hours a day. So there may be cultural things going on where people are not willing to put in the work. That's a bigger issue. And look, I can tell you the Fed is not going to change the culture of work. That's where maybe you need to have a conversation with your millennial son or daughter and say, hey, you know what, you need to show up every day at 8 o'clock and you need to be that worker who's going to work the full day.
We've got time for just a couple more. Go ahead.
Oh, okay, then we'll get to the, why don't we go to the, she's been waiting. Go ahead.
Oh.
So my question for you is, when you were talking about the requirement for the banks to have the 20% down, the reality is that will trickle down to the customer.
Yep.
So I'm involved with the National Association of Realtors, so that would have a direct in everybody in this room, and how much money they put down into a home and all the first-time home buyer programs and those kinds of things. I don't necessarily see that as a bad long-term thing, but what do you think? There's going to be a curve in relationship to that. So how long do you think our growth and learning curve to get back to a larger down payment would be, and what would be some of the impact of that time period?
Yep. So this is about costs and benefits underlying your question. And this is all about, you can never make the risk of a financial crisis zero, just like we can never make the risk of terrorism zero. And think about physical security. We pay for law enforcement, we pay for homeland security, we pay for our safety when we go to the airport, where we're a little bit inconvenienced going through the metal detectors, et cetera. We as a society have to decide how much safety we want and what price we're willing to pay for that safety. Well, we did the same math on the various capital ratios of the banks and said, what's the economic cost going to be? It's not free if we raise the capital requirements on the biggest banks. We did the analysis, and we found that the cost benefit clearly is better if we raise the capital requirements of the biggest banks and avoid the 2008 type crises. Because it's all well and good to have this really booming economy, but then if every 20 years or every 50 years you pay the price with this devastating crisis, is society better off or not? And so underlying your question is about trade-offs and costs and benefits, and that's exactly what we tried to optimize when we developed our plan. And I'm giving you a very quick answer. All the details are on our website, which you can just go to minneapolisfed.org, and you can probably read far more about it than you'd be interested in, but it's all there. So thanks for asking it.
Go ahead.
If you could think about what the 1, 2, or 3 greatest vulnerabilities of our nation are, what would be the things that most concern you looking forward?
Well, we talked about the too big to fail issue. It's not an imminent threat, but if you go back to what caused that crisis, at its root, we had a nationwide delusion that home prices only go up. And I bought a house in California in 2005, so I'm as guilty as anybody, okay? And societies are prone, human societies are prone to these mass delusion events. It's going to happen again. And the question is the financial system strong enough when we make that stupid mistake, that'll be stupid in hindsight, does it require a massive taxpayer bailout or not? So that's why I'm so focused on too big to fail. Otherwise, I do think we need to get our political dysfunction a little less dysfunctional, right? I was with a member of Congress yesterday or the day before when I was in Washington, and he asked me what could cause a big stock market correction. You know, there's a lot of political anxiety in this country. You know, we make some bad choices, that could lead to a correction. And so one of the things I think we as a state have in our advantage, whenever I go to Washington, I meet with our elected leaders who represent our district. You know, Minnesota's delegation is pretty bipartisan. I mean, we got Republicans and Democrats. They all get along. They all respect each other. They're all able to talk to each other and work on issues. And I think that discourse is a good model for the nation. And I think if we could get a little more conversation going, I think that would reduce some of the tensions and maybe reduce some of the risks that we face.
We're about to wrap up, but I just wanted to touch on local and regional. You touched on employment here regionally and as part of your charge to bring that to the FOMC. What else should we know, or what are some insights about our local and regional economy that maybe have surprised you, or some things that stand out maybe since you've been here?
Well, I think, again, the strength is the diversity of the economy. All the major sectors are here, whether it's manufacturing, healthcare, services, ag, mining. I mean, they're all here in pretty good size. So that's great. That serves us well because there's always some sector that's down, and they're helped by the other sectors that are up. Now, the Dakotas and Montana right now are really suffering from a drought. Their ag sector is really getting hammered from a drought, which I've heard a lot about, and I'm going to be going to South Dakota soon. And again, I think our workforce is a real source of strength for Minnesota, but we got to keep working on education. It's a source of strength. We got to keep investing in it. We have to keep making sure that our workforce is as educated and as skilled as possible, whether it's the skilled tradesman or woman, or it's the college graduate, or it's the PhD. All levels are really, really important. And as I travel around, it's usually that skilled tradesman or woman that are lacking, where small businesses are saying, I can't find that electrician or that plumber or that welder. And so making sure that we are, filling those pipelines as much as we possibly can.
Great. All right, so one last lighter question, something that I really need to take Neel to task with. His staff has informed me that he is in favor of a bad winter. Is that fair to say?
So everyone warned me about the vaunted Minnesota winters, and the 2 winters I've been here so far haven't been that vaunted, and so I'm waiting for the real Minnesota winter. I will say this, my wife and I have 3 big dogs, Newfoundlands. They're giant, hairy monsters. And in December, I tried to take them out. It was minus 20 Fahrenheit, so I said, let's go for a walk. 2 of my dogs turned around and went back inside. The puppy was all for it, and we went for a 20-minute walk. So
Well, I can't wish you good luck on that particular need, but I want to thank you. Thanks to the City of Woodbury. Thanks to all of you for attending, both chambers that organized the event, and thanks to President Kashkari for his attendance and insights today. We really appreciate it.
Thank you for having me. I really appreciate it.